Thank you. Welcome, everyone. I'm John McArthur. I'm a senior fellow at the Brookings Institution and also a senior advisor to the UN Foundation. And we are here to talk about investing in sustainable development for the next hour. We have a very world-class group on the panel and certainly a world-class audience, knowing a few of the faces who are here dealing with these issues day to day. And so maybe I can just start by introducing our panel and then share some thoughts, and then we'll hear from them and hopefully have a bit of chance to hear from the room before the end of this. We have, I'll just go from left to right. We have David Ray, who's the head of investment analysis at the New Zealand Superannuation Fund. He comes from a lot of experience previously at the OECD in Paris and also National Bank of New Zealand, Reserve Bank of New Zealand, so an investor and an economist on both sides of the equation. Aimée Christensen, who is a CEO of Christensen Global Strategies, but also executive director of Sun Valley Institute for Resilience, and worked in pretty much every type of organization you can think of, from the Department of Energy and the US government to the World Bank, Stanford, and very involved with the UN Sustainable Energy for All initiative, and brings a lot of practical and policy experience to this. To my right is Christopher Ailman, Chris, who is the CEO at CalSTRS, probably needs no introduction in this audience of all places. But he's, of course, CalSTRS is, U.S. largest teachers fund, second largest pension fund, but he's also very involved in these public debates on how to think about sustainable investing. I had the privilege of doing a little bit of homework and seeing a lot of the really cogent, I thought, public comments you've made on this in the past couple of years, and very, very insightful. Also co-chair of the Milken Institute's Global Capital Markets Advisory Council, so plays a big role in this community's discussions. At the end, last but certainly not least, we have Reyaz Ahmad, who's the CIO and head of asset management company's Funds of Funds group at the International Finance Corporation, IFC, which is the private sector lending arm of the World Bank Group. He was previously leading the IFC's team in investing in renewable energy and supply chains around the world, and worked a lot in oil and gas in many parts of the world. So it brings a lot of perspective, again, from the strategy to the brass tacks to the global perspective. And we couldn't really ask for much more in terms of a great group. We're here, as we know, to talk about investing in sustainable development. That's our title. I think the opening question is, what does that mean? So Mark Carney, for example, I'm a Canadian, we're all proud of Mark Carney, who's of course, the governor of the Bank of England, but equally, if not more importantly, the chair of the Financial Stability Board, has made a number of very important public statements in the past several months, which are perhaps uncommon for someone of his background and position. Before the Paris Climate Summit, the COP21, he made major statements around the risks of so-called stranded assets and the, not on an ethical basis, but on an investor basis of managing risk for the long term as part of his mandate in the FSB role. Just 10 days ago at the UN, there was a major event on the implementation of the Sustainable Development Goals and also the signing of the Paris Accord the next day on Earth Day. And he made what was for me quite a pleasantly unusual speech. Again, for someone of his line of work, it's not the type of cross currents we usually see coming together, but he talked about the Sustainable Development Goals not just as a moral imperative, which they are, but as an economic imperative. And I think this is the heart of what I hope we can talk about today. What's the essence of that economic imperative? He's talked about it from a vantage point of managing risk, but also the essence of greater productivity, improved labor force, stronger growth. Even he talked about the SDGs as a part of a solution to the current growth conundrum that the world is seeing today. Interesting, I thought. When we think about what does investment mean, often what kind of scale are we looking at? The numbers are tough to aggregate. As a practicing kind of macro and global development economist, think about these numbers in context. So it's maybe 5 to 7 trillion a year of investment that's needed. One level, that's a big scary number. That even for the biggest investors in the world.
No, that is a big scary number.
It's a big number. Fortunately, for those of us who don't invest, who just do numbers, it's not that scary because it's an $85 trillion global economy that's actually growing pretty reliably on an aggregate basis. So when I hear that the developing world needs an extra 1 to 2 trillion a year of investment, I say, well, what's that? We're at $10 trillion investment per year in the developing world to begin with. That's a 10% increment. We're probably going to grow our way there anyway. The question is, how does the right scale of investments go to the right types of activities? Because the current path of investment is generally understood not to be providing enough sustainable development. So if we look at even what goes into those numbers, the heart of it is typically infrastructure, energy, power, transport. Significant amount is for agriculture. It's less for things like health and education. They're important, but not the big numbers. And so the question that I've asked our panel to start out with from each of their own perspectives is, we have these new things, the Sustainable Development Goals, which the world set for 2030 for all countries to actually define sustainable development across 17 dimensions: health, education, inequality, smart cities, clean energy, jobs, employment, so forth. We also now have this Paris Agreement, landmark agreement, step one on a new trajectory for the world attacking its climate problems. But so what? What does that mean when we think about the trillions that are needed? What does it mean when we think about scale and moving from projects and what one might historically have thought of as CSR and moving to core business? Because you don't get to the trillions off CSR, you get to the trillions off core business. And so maybe I thought we could start with Chris, as someone who's both managing a massive fund, but has really been thinking, I think, as much as anyone about how do we think differently about this, and so what?
Well, from my perspective, it's interesting to look at Paris, because I look at Wall Street, and there is a huge chunk of Wall Street that has just looked at Paris and kind of ignored it. But from our perspective, it actually was huge, because even just the months leading up in the last summertime, I was hearing numbers that the best they were going to do was a 3-degree rise, 3.5-degree rise, which I thought, oh boy, this is really going to impact our world. So to see the nation step up to a hard commitment is awesome. But as you said, now that's step one. Now the challenge is actually implementing it. It's great that many of the things are mandatory, but already hearing different regions of the world where different parties come into power and already want to push back on that or renegotiate it. For us, the key has always been, we need a price on carbon. I thought, we've heard Al Gore, we invest with generations. We have heard Al Gore's presentation many times. But I love that picture of the Earth and the thin layer of atmosphere. Because we sit here and we look up at the sky and it does seem endless, but when you look at it from outer space, you realize, okay, it's a very thin layer and you're using it, as you said, as a sewer. You've got to then establish a price to dump that. We pay a price for our physical waste. We pay a price as consumers and as companies for water waste. We need to pay a price for gaseous waste. And then I'm convinced the financial markets will come in and solve the problem. You don't have to rely on the government to set regulations or cap and trade. People will eagerly come in, because when there's a price and price goes up of, say, burning carbon, then all of the alternatives are much more marketable and we think going to represent a ton of investment opportunities. So for us, it is a challenge looking forward, trying to guess when these things are going to come into effect, when governments are going to make regulatory changes. That's an active management decision, and I have to say, we don't really like a lot of active management decisions. It's predicting the future. And I constantly remind the board, that's a really inexact science. So from our standpoint, we'd like to see some of those things play out. We're going to continue to invest. We think this is a mega trend, and for us as a big boat, we're looking for those kinds of, in California, we call it a mega wave. It's something we can get on, catch up with, and ride for a long time, because there is the huge amount of money that needs to go, particularly in infrastructure, that needs to go to work to implement all of these changes.
That's great. This price on carbon question,
Yes.
I hope we can maybe come back to a little bit later. How do we get that? Because we're seeing more and more businesses call for it, but how do we get over that hurdle? Maybe David, I can ask you to jump in. You guys just put out a very nice paper, Why We Believe Responsible Investing Pays Off, I think was the title. And it's broader than just the climate energy bit. It talks about the kind of spectrum of ESG. So maybe can you tell us a little bit about that and how you guys have thought through this kind of core rationale of thinking about investment differently?
Sure. And thank you for the plug for the white paper, which is on our website. I mean, we've had a belief about responsible investing and why it's good for the portfolio, why it's good business. We've had that belief as an institution for around about 10 years. And it's probably fair to say that when we started, it was largely a belief. It was based on, a gut feeling, observations of markets and so on. Since then, in the intervening 10 years or so, I mean, there's been somewhere between 100 and 200 really, high quality academic studies of that question. What's the impact of environmental, social governance indicators on firm performance, on stock market performance, and so on? And I think the body of evidence that's accumulated since we first articulated our belief has become pretty overwhelming. It's pretty hard to deny that companies that do well on various ESG metrics perform better at the company level, they have a lower cost of debt, they'll tend to have higher stock price growth and so on. You just look into that, you look at why is that. Some of these are not too surprising. We know, for example, that good governance has been a priced factor for a very long time. There's no news there. But I think what's become interesting is the accumulating evidence around environmental and social as well. When you look at climate change as well, and we've done a lot of work in the last couple of years trying to develop what's essentially a holder fund climate change strategy, where we've applied this belief about responsible investing pays off to climate change, and so what do we know? What do we learn about that? And I think looking at the way that the market, if you like, is pricing these issues, we've become pretty persuaded that it's not. That if you look at the risks around stranded assets, if you look at the valuation of 1p or 2p reserves on corporate balance sheets, if you look at how analysts actually price equities and the extent to which they factor in stranded asset risk or climate risk into their risk discussions or the conversations that they have with CEOs and boards, it's pretty clear that Wall Street just ignores this issue. Now, they may be right, but it's a very extreme position to take. I think we've become pretty persuaded that there's a material probability that one way or the other there will be a carbon price in the future. The market's not pricing that in, and there's some pretty sensible things that we can do about that from an investor point of view. The other observation I'd make is while COP21 was pretty important, as an investor, policy is clearly one of the drivers for the change. I mean, what do we believe? Just to step back for a moment, we really believe that the global energy system has to change, and it will change. But we don't know how and we don't know when. And there's going to be some drivers. Policy is one driver, but I actually think that policy is playing catch up. As an investor, I worry a lot. Actually, I'm excited about it, but I focus just as much on technology as a risk. And also on civil society. I think civil society is probably having a bigger impact than policy at the moment, and that's something worth bearing in mind. So it's not just the hot air coming out of Paris that's driving this. It's a whole lot of potential innovations. There's some very smart people working on these problems, and the pressure coming from civil society, I think, is going to be an important influence on companies as well. All of those things are going to factor into the outlook for anyone who's fossil fuel heavy.
Well, we're seeing, of course, states like North Carolina, the role of civil society in business right now. It's a live topic for many reasons. Aimée, you've been thinking about this at all stages of the investment pipeline, for all stages of the technology pipeline, as we were talking about just before. How do you think about this and how it can be approached in a more strategic way?
Well, thinking about what happened with Paris and the Sustainable Development Goals from an investor perspective, clearly there are risks, but also it's real opportunities, because now governments have said these are areas in which they're willing to act regulatorily, changing policies, creating a more optimal investment environment for low carbon economy investments for across all of the 17 Sustainable Development Goals. What are those sectors? Identify country by country where their priorities are. Where are they ready to welcome investment to help them meet those goals that they're going to be held to account for by 2030? And that's where the investment opportunities are going to be, and the opportunities to shift the regulatory environment to optimize your investments to help them meet those goals as well as benefit your bottom line. So I think from a global strategy perspective as an investor looking for those markets, really understanding where the priorities are for those governments to meet the 17 goals and meet the Paris targets, and look at their nationally determined contributions. In Paris, You had 195 countries agree, and then you've had 186 put forward these nationally determined contributions, what they're going to do on climate change. And that's a roadmap to understand where are their priorities in the low carbon economy. Is it shifting to renewable energy? Is it reforestation or just continuing to maintain their forest cover? So in the case of Bhutan and Costa Rica, for instance, who've been ranked some of the highest contributors to the climate agreement, for them it's more the forest sector. What are the opportunities there in their carbon markets or otherwise in some of their commodities markets? And in other cases, in China and India, for instance, massive solar goals were part of their nationally determined contributions. So investment opportunities in those sectors because they're going to be aligning their markets to meet those goals. So I think thinking about it from a global strategy perspective, but then also more locally. What is that local community? You talked about civil society. What is the local community looking for? What are they opposed to? What will they welcome as far as an infrastructure investment versus what will they be pushing back on? So I think really understanding who the localities are and where the priorities for those social and environmental outcomes, where do they come from? They don't come from on high, but the local communities where you're operating, where are those priorities, and determine your investments accordingly.
Just on that,
Yeah.
is there enough of a pipeline for these things? That's a big debate that, a lot of investors are looking for deals, but there's not enough deals ready to go.
Yeah, and I think in an early conversation, somebody said there's plenty of money ready to go. Just give us the deals in a form we can invest in, right? That we understand and can understand as investors. Certainly, a number of people in the foundation community are looking for impact investments, for instance, water-related investments. They're putting philanthropic capital on the table, working with environmental groups and local communities to source water-related impact investments, realizing that they need philanthropic money to shape those investments and bring them to them in a way that those foundations can then use their investment resources to invest. So they realize you have to do a bit of what we've talked about, I think, is blended capital, where you come in with some of the philanthropic money to shape the investment, to make an investment ready for more traditional investment requirements from a risk and return basis. And I think also in that context, that may include some regulatory changes. You may have to change the local water policy, and I can speak to that and what we're doing locally in our area, because water policy can really determine your agricultural activities and a lack of investment opportunities if there's too much pressure to continue to use water.
We're having a session next on water in America, if you want to go. Infrastructure investments. Reyaz, you're in the middle of a lot of those debates at IFC, focused on the developing countries, but also these questions of how to accelerate pipelines. How do you guys look at these issues of mainstreaming?
So let me start with the broader topic of sustainability and then come to the climate, the narrow topic of climate in a moment. So on the sustainability thing, I think it's, to pick up on some of the points that have been made earlier, it's for us, we have clear evidence in our own business that these things are really not separable, meaning a focus on investing sustainably and investing for economic return. As many of you know, IFC is the largest or one of the largest investors, multilateral investors in across the developing countries. Everything that we do is in developing countries. Last year, we did about $18 billion of investment across over 100 countries, 500 or so transactions, and across all of that, it is focused, or it is integrated. The focus on sustainability is integrated in our investment operations, and we've been doing this now for a number of years, and we have clear evidence in the outcomes, the development outcomes, as well as the profitability outcomes, that this works very well. So IFC is a profitable entity, invests on a double bottom line, and it has been profitable for since it was begun, but the sustainability focus has really helped in that respect. And I would say also that in commenting on the transition that investors make, we also, I think, have gone through transition. I've been in IFC long enough that I saw, this transition and how painful it was to make sure that the focus on environmental, social, and governance issues was mainstreamed in our investment operations. We learned it through hard experiences in some of our very early investments that we had challenges with, and we integrated that and then learned from that and built upon that. So I think there's clear evidence that we don't differentiate really from that. On the climate related aspect, we have, first of all, been working very much in a focused way on that in our own investment operations. We can talk a little bit, break down if you want how that breaks down. But we did last year about $2.2 billion of climate-related investing in 103 countries, 31 transactions. Our calculation that was published is that in 2015 alone, 9.6 million tons of carbon related to our investments was avoided. So it's a clear focus now. We have, and it's related to the Paris agreements. We've committed to effectively double this activity between now and 2020. So it's a core part of our activity. We're a major investor in the power sector already. About 70% of what we do is in the renewable field. And again, we're not trading off commercial returns with respect to this aspect. We're trying to integrate and to look at them together. I would just say, just in closing on this point, I mean, I think the real issue is how do we get from the individual deals that we've been doing, a lot of and will continue to do, how do we get to the scaling of this to a much bigger challenge? And so I think that is really the debate.
And on that, I'd love to ask you, Chris, because if we take David's thesis that these are mispriced or non-priced, and we take the view that this is maybe not because people are looking at the wrong issues, but looking at the wrong time horizon. And that's the core of the problem. So we're used to talking about sustainable versus not when we should be looking at long versus short. And that's how to push it in the middle. Does that resonate, A? Or B, like, how do you think about this scale question to go from projects to norms? Because it seems like there's a market failure on the pricing side if these arguments are right, which there's more and more evidence that they are.
They are, but there's that level of uncertainty. We have seen too often companies that have short-term gains by cutting corners, polluting rivers, or avoiding economic sanctions. And so I think in our case, we think long-term, but it is hard to price stuff out as you get into farther out into time and the uncertainty. And scale is something that's important to us because of our sheer size. We've done lots of clean energy investments, and like any new technology, we've lost our share of money. And as the price of photovoltaic has just dropped like crazy, which is great, but when you own companies and you can't keep up with that pace, and it's inevitable when you're a public fund and you've made some initial investments and they haven't panned out, there's not a lot of interest to go back into that area and continue. So to us, that level of uncertainty is tough. We've made some investments in very simple technologies that we think actually make a lot of sense. And there's going to be a huge market in energy efficiency of just using, however the electricity is generated, using it more efficiently. We've looked into batteries, but that really looks, there's a good example of holistically, batteries are seen as the near-term solution because you can at least find a way to store the solar power. The problem is batteries oftentimes really are actually worse for the economy and for the environment than anything else. So for us, it's interesting, just particularly in the area of development. We've done some specific projects, particularly one in the California desert, works well, but will not have scalability in California. As we've said, if it gets built out, it'll be built in Nevada or in Arizona. One simple reason, environmentalists in California care about the desert tortoise. It's sad, but it's true that in Nevada they eat desert tortoise, so they don't mind building out and just trampling the ground. So development is really hard. And when you mentioned, I'm sure in Aspen it works really well, but
I'm in Sun Valley.
Sun Valley, sorry,
Better.
even better. I can show you the hate mail that we've gotten from citizens in the UK because our wind turbines are too big and they make noise. And so it's like, okay, well, good thing for making the turbine and doing wind power, but then when they write the governor and they complain, although California doesn't really care that much about the UK, but it's always hard to pull off both. How do you do development and think long term, but then also know it's going to cause disruption in the near term?
Just to
Yeah.
just to pick up on this point about how you scale, I think I think first of all one has to recognise there's a series of barriers or obstacles. I mean, it's a wide range of different things, from local regulation, even the most basic things about rule of law and the ability to enforce contracts. I mean, the very basic things in emerging markets I'm talking, but. And maybe just to give some examples of the type of thing that you could do, or that we've tried to do in this. One of the areas that we focus on is trying to create standards, or to get market participants to buy in to a standard that will be recognized. And it's sort of everyone buying into this means that it becomes the established standard, and helps everyone to say, and particularly helps financiers to say, okay, this meets a certain standard. And therefore, it's good, and it meets a kind of a seal of approval, although we're not giving any form of seal approval. We did this first in the environmental, social, and governance issue with the Equator Principles, which is a set of principles based on our own environmental focus, which is now I think the global standard for bank lending into projects. But more recently, in the climate field, in energy efficiency in buildings, we have developed a standard which is called the EDGE standard. It's an online tool that enables a developer to go in and experiment with the building design and compare what they would achieve. Estimates the cost of what they would need to pay, but calculates what they would achieve relative to the average in that area for that type of building. And so to give a clear sense of some of the trade-offs that they need to make between cost and the ability to save GHGs. So this is a non-investment. I mean, we follow this obviously in our own investment activities, but it's a non-investment way of trying to change the platform, trying to change the playing field, to try and say out there that, look, actually you can do this, and these are commercial buildings, you actually can make money out of it, but you do it in a way that's environmentally sensible and climate smart.
Well, and I'd say in real estate, the real estate industry has taken this up faster than anybody, because it has translated into return. Tenants want cleaner buildings and greener buildings, and so they realize, okay, that increases the value of my rents, increases the value of my building. And you've done two things there with that. The second bottom line is you've established a standard measure, and then therefore people can translate into something of a price. Because that's really, like you said, the challenge is that mispricing, that perception of risk and that opportunity in the future.
So just back to David then, as a national entity, a major player, but from a mid-sized economy in the world markets, there's questions of how does an individual institutional investor approach these comes up. Carbon pricing, but everything in terms of coordinating on new standards. How are you guys seeing these issues in terms of how to be front-footed when there's a large tide moving in many directions?
Yeah, it's difficult. It doesn't matter how big you are. Actually, it's difficult for any individual investor to be acting alone. So I mean, we're as much as we can, we're trying to club up with other investors on the investment side and on the engagement side, engaging with companies, and in terms of policy engagement as well. We try and be engaged in the policy debates back home in our own backyard, and trying to give the long-term investors perspective around developments in climate policy, for example. And we try and engage as much as we can with corporations around their approach to climate risk and other sorts of environmental, social, and governance risks. We've got we're part of an initiative as well, the Aligned Intermediary Initiative, which was around half a dozen long-term investors getting together, just looking for a clearinghouse platform, if you like, for climate-related solutions. We've been involved with co-invest clubs, which have invested in some specific alternative energy technologies. So just trying to leverage off the expertise of others. So I think investors have to work together on this. But the real, the difficulty for us and for any other investor, I thought for most other investors, is the fundamental problem of picking winners, and the real difficulty of picking winners, and the importance therefore of trying to make sure that from an investment point of view, you're spreading your bets as widely as you can. But there's a real trade-off there, obviously, between truly knowing what you're getting into, direct investing versus spreading the bets, which is why I think something like Reyaz's platform, which is a sort of fund to funds approach, makes a lot of sense for investors. And I think probably you'll see investment solutions going more and more down that line, because I think it's like any area of venture capital or any area of technological uncertainty. Picking winners is very, very hard. So if you want to be playing that game, you've got to be having your fingers in as many pies as you can if you want to succeed.
But I think a question to ask there is, how do you know the impact you're having, right? If you are more removed and not doing the direct investments where you can really track that more effectively, whereas if you're in a fund of funds, how do you know the impact? And I think we haven't talked yet really about metrics, but what are those social and environmental metrics, and how do you really know this isn't just greenwashing, or we were talking about SDG washing your portfolio before? How do you know that you're making those social and environmental impacts? What's that structure that you're providing with more and more foundations, family offices, endowments wanting to see what those social and environmental impacts are of their investments? There's going to be that requirement. So I think I'd be interested in Reyaz from the IFC perspective.
Sure.
You all have been, over the years, of course, engaging local communities on the social and environmental impacts of infrastructure projects, but more generally, as you look at investing for these outcomes, I'm curious about how you all are looking at that.
So clearly at the front end, there's a lot of engagement. We have a very comprehensive approach based on our performance standards to identify the potential issues, engage with the communities, and so on and so forth. So that part is in a way not easy, but I'm taking it for granted, and people can read about it. But on the measurement issue, so what we've developed as a practice is every one of our investments that we make goes to our board for final approval. In the document that goes to the board, there is a section which is the anticipated impacts. And so this is carefully developed and then scrutinized by the board in making their final decision on an investment, and then we have to report back on that. What this means is this is called a development outcome tracking system. What this means is we require the companies and funds that we invest in to report on a set of parameters which is predefined, which is what we were seeking to achieve over the life of the investment, and then we measure, and they're independent entities within the bank group that look at that and evaluate and try and learn the lessons from what has worked and what has not worked. So there's a kind of and that data, by the way, is aggregated and then reported. So it's not reported on an individual basis. That would be confidential, but it's aggregated and reported in our development reports. So we've tried to build in from the beginning what it is we're trying to achieve, whether it's employment, women employment, supporting green energy, green buildings, whatever it is we're trying to do. We try to put a metric around it, a time frame around it, and then actually collect the information and report against that.
This question of metrics, I think, is so interesting. If I were to paraphrase, you were just talking about sort of project level metrics, kind of project level outcomes. Very important, obviously, the unit of investment. But there's also this notion of kind of comparability across activities. And sometimes you can do that project by project, but if you're an operating entity, or it's one of many things you do, you might need a way to kind of compete as an organization. Mm-hmm. And I have the hypothesis that one of the big problems with the metrics game until now is that it's been compliance-based rather than performance-based. So most good CEOs want to beat their competitors. They don't, of course they don't want to be put in jail or called bad names, but they want to win. And so I'm curious what you think are the best kind of seeds growing right now in this area. We were talking a bit beforehand, I'm a big fan of the Sustainability Accounting Standards Board, which Mike Bloomberg's been backing, many of you might know it, but they've just issued the 79th and final industry level set of metrics where they actually went through. You can't put an energy company next to a technology company and use the same metrics. That's just not interesting or useful. But over 79 industries, you can start to get a bit of slice and dice of relevance of what's comparable. That's in a public conversation right now. The SEC, I know, has even just issued a kind of call for comments on these topics of what's material. But I'm curious, that's just a bit icy, but I'm not in the investor market. And those are public market focused questions, of course. But how do you think this notion of comparability should take shape so that we can have a real sense of performance on the right sets of issues? Anyone want to jump on that?
I'll jump out because we're a huge fan of SASB. From our perspective, there are too many people asking companies a variety of questions. There's questionnaire fatigue, and people are using different metrics in different time periods. So standardization will make the investment analysis that much more clear. People can decide whether it is going to have an impact in the future or not, but at least the information is uniform. The time period it's covering is uniform, so you can compare company to company in an industry and that company across time. The key to me, to the SASB statistics, it's material. So it is identifying in their consultation with each industry, not all of ESG, but is it an E, is it an S, or is it a G factor that is material that impacts the value of that industry. In a nutshell, financial analysis is focused in on the balance sheet, the income statement, the financial statements at the front. But those are a snapshot into time or rear view mirror looking. What really matters is in the footnotes, and that's where companies disclose technically what's material, but oftentimes lawyers have just loaded it with so much information it's immaterial. But that's where they tell you about the forward-looking risks to the company. That's where we think the SASB standards need to be integrated. We're pushing the SEC to integrate them, make them mandatory so that we can get them in all of the reporting documents that can get fed through the financial system. So when we're making an investment decision, even at the company level, we'll be able to compare and get better stats on E, S, and G instead of somebody else's survey or somebody's rating or somebody's 10-point system for governance. We need those consistent metrics.
Right. You guys have been involved with PRI, Principles for Responsible Investment. I think you were founding members, maybe even.
Yes.
Out of curiosity, does the SASB conversation, for example, percolate to you guys, or is it, because there's a little bit of a European conversation and an American conversation on these things, some for good reasons, some just because people don't talk enough. And so curious, how do you find that as in neither, in kind of between the conversations?
Yeah, well, I think we'd agree with Chris that we think the standardisation of information, some clear reporting of information, the standardisation of that is going to be really important. We don't have a particular view on it at the moment on one standard versus the other. I don't have a strong view on that one, but I think we're great believers in what gets measured gets managed, and comparability is reasonably important. But there are some markets, including our home market, for example, where the amount of information that's released is just almost non-existent. So I'd actually just be quite happy if they just told us anything, almost anything about what they're doing and how they're viewing environmental, social and governance issues, how they think about it from a risk point of view, how it impacts their business. So I think different areas, some areas are way behind others in terms of the transparency of the information. As soon as you start collating, releasing information, you're doing two things. One is management teams are actually forced to think about, well, if I'm going to publish this piece of information, what does it mean and how am I going to justify that? And if this is bad news, then what sort of story can I tell? So that gets them actually thinking about what that means for the business. But it improves the dialogue between investors and management. We can have a much richer dialogue if it's a fact-based discussion.
What do you think? You've been involved with so many angles of those questions.
Yeah, actually, I was thinking more about, we've been talking at such a global level, and what I'm seeing at the local level is, I think, also relevant at the global level, which is the risks that we're facing from climate change can also be the opportunities. And if you're looking strategically at what risks in a community are, for instance, in the case of water. So you have water, where we have calls on, we have legal battles over water rights. For the farmers who are saying to the cities, communities, you can't use your water anymore, we have more senior water rights, and the priority is agricultural use. And so real legal battles happening already. We had the second biggest fire in the country 2 years ago, which immediately hit cost us a quarter of that quarter's economy. And we have a very dirty old grid that has gone down several times, including in the heart of tourism season. And as much as you joked about, Sun Valley and the levels of wealth in places like Aspen and Sun Valley, 50% of our county residents are on some form of public assistance, because often you have certain industries, including hospitality, that don't pay particularly well, and you also have seasonal jobs. And so when we look at these risks facing on a community level, those opportunities are to invest in local energy, a more resilient grid, potentially islandable microgrid. The current grid is 35% coal. You put a price on carbon, that's going to hit consumers immediately. And so we can do, and as we did about 6 weeks ago, we launched a Solarize campaign, and what we did is an RFP. We negotiated reduced prices. We have 125 people already signed up to go solar very quickly. We got local banks to offer financing. We addressed the regulatory barriers of solar permitting to make it easy for people to get the regulatory authority to go solar. We addressed systematically what were those barriers, we created the opportunities, we educated the community, and then people move forward to invest in a sector that's going to create local jobs at a higher pay scale than what has been traditionally the area's industries. And at the same time, in the water sector, we can actually pay farmers 1.5 to 2 times what they're getting paid for commodity crops like barley and alfalfa to do solar and sell into the grid. So it's thinking about this, I think, in a holistic way, even at a local level. There are some real opportunities to address multiple goals. So the economic returns, the job creation, the climate impacts, mitigating those impacts to the economy, and as well as we're decarbonizing the economy and switching out of agricultural activities that use more fossil fuels, for instance, and go to local food production, which is another economic opportunity. Local food production, higher value crops. Again, you can make higher incomes for those farmers, use less water. But again, you have to address the regulatory framework that you're in. We have use it or lose it water rights, which means that farmers are incented to grow alfalfa for export to places, including in China, to feed their animals. I mean, this is, talk about high climate change impacts of our agricultural activities. And so aligning those regulatory frameworks and thinking about how we can work with governments to shift their thinking about their future economies. What are their strategic industries? In our case, we have a huge solar potential, and we think that that's a strategic industry for our state, but we have to educate our decision makers that that's the case and push back against legacy industries, the utilities who may not necessarily want to go there yet, want to keep running their coal-fired power plants. So I'm just thinking about this dynamic that we're in. There's the global questions, but at the local level, I think thinking about risk, but also turning that into opportunity and finding investments that you can make that have multiple returns for energy, for food, for water, for climate, for job creation. Really trying to find those multiple impact investments.
We have about 15 minutes left in the session. I just want to make sure we check in. We've heard so much, I could ask 100 questions to each of these terrific panelists, but want this to be useful for the room as well directly. So I'm just, if by show of hands, you don't have to, I've got lots, but does anyone have a burning question they want to ask or raise or issue you'd like to make sure we discuss before we go? Yeah, Mike.
So I've got a question.
And sorry if you just introduce yourselves for those who don't know.
Sorry, hi, I'm Michael Perkinson from Guggenheim Partners. I've got a question about how you assess the genuine sustainability of a project in the pre-execution phase. We've spent a considerable amount of time looking at what standards are used by the World Bank Group, the EBRD, and we think that there's great strength in a number of them, but we think that there's improvements that can be made, especially in the pre-execution phase. We think, and we could be wrong, that a lot of what happens is mitigation. During the execution phase, and put very, very simplistically, I'm going to kill a bunch of caribou over here, so would it be okay if I planted some trees over here? Thoughts on where we are and where you would like us to be?
I'm going to suggest we take a couple. I saw another hand. That's a great question. Pre-execution standards for sustainability across the board. Yeah, please.
Hi, I'm Ahmad with the Global Impact Investing Network, and we're a network of impact investors around the world. And really appreciate the conversation, so thank you. My question for you is just, we talked a lot about some of the challenges and issues and the structuring opportunities. If you were directing more investors to invest in specific opportunities, just curious, where do you think the opportunities are to have a tremendous impact on sustainability, and where do you wish investors were focused? Thank you.
You mean in terms of opportunities there can make a difference in this?
Exactly,
Yeah.
exactly.
Okay, great. And maybe one more just to round them out.
Yeah, hi, David McCauley. I'm with World Wildlife Fund and former climate director at Asian Development Bank. I'm curious about getting back to Wall Street ignoring the stranded assets and pushing for a global carbon price is one way to price that in. We see like the FSB, this Bloomberg working group that's trying. It seems like they're trying to ease the market this information into the market so that you don't get a major discontinuity, waking up one morning and having fossil fuel industry and everybody who's fossil fuel heavy stocks fall overnight. I'm just curious about whether you see that as occurring anytime soon. Is it going to be a sudden thing? Is it something that, how do you get it priced in short of, knitting together cap and trade programs around the world, which seems to be the strategy?
So I'm going to suggest we take those here because we have a full plate already. So just to summarize, how do you assess these pre-execution standards and define them? What are the opportunities you might direct someone towards if they wanted to go here? And then this question of carbon price, how do we actually get that carbon price? And on that, I just want to throw out an extra layer, if I may, which is I work in a lot of these global policy circles where people say, oh, if we could just get the institutional investors to send the signal, because they're the most influential investors in the world. And you're sending the signal. And we have...
Yeah,
no,
I've had this pressure all the time. It's that if we build it, they'll all come.
Well,
It
and so
doesn't work that way.
my question is, there are several major investors who are sending that signal. There are more and more corporates that are sending the signal. What's the theory of change to get there, if I could say? Because we're not there yet, even with people like you, both you guys on the major institutional side calling for this. So how do we get there? The World Bank, of course, too. But how? So those three things. So who wants to go first? David?
Maybe I'll pick up on the carbon price question because I think the issue about a carbon price is you're going to get one no matter what, one way or the other. And you're either going to get a coherent, well thought out carbon price, which might be a carbon tax, which might just be the major countries individually putting that in. It might be global. You might get cap and trade systems. You might get the tie-in together of some cap and trade systems globally. I'm not super optimistic that you're going to get a nice, neat, tidy, clean, coherent global carbon price. All right, but you're certainly going to get a carbon price through the back door, and that's going to be through the pressure that civil society exerts directly on companies. That's effectively going to be a carbon price. So it's not explicit, but it'll be an implicit one in terms of the pressure on individual companies and the demand for the goods. And I think you're going to get it through regulation as well. The thing that I worry about most in terms of the outlook, and this gets to the point about the time horizon thing, the thing as an investor I worry about most is that we go towards a world of random, unpredictable, fairly incoherent, and in many cases probably fairly costly regulatory interventions. So an industry might be sailing along quite nicely, thinking they're flying under the radar in terms of the regulators, and then the industry just gets sucker punched by some specific recommendation that goes to that industry. And I think that will be unpredictable. That's probably the most difficult thing to deal with from an investor's point of view, and it's one of the reasons why I think markets are not really pricing this stuff in. It's not because they're stupid, it's not because they can't see it coming, it's because of the unpredictability of how it's going to manifest and when it's going to manifest. And most investors have a time horizon, a career horizon that's just way too short. They can't take bets that might pay off half a decade or a decade or a decade and a half in the future, whereas long-term investors, that's the advantage that we can have. So how this gets manifest, I'm not sure. I fear it'll be messy and unpredictable. So I think what's really important is that all long-term investors keep the pressure on to try and have as coherent and as sensible and as global a pricing mechanism that is politically sustainable. You'll never get first best in this world, but if we can muddle through to something second best that's reasonably coherent and covers, 2/3 of the major economies, I think that would be a huge success.
I mean, just picking up on that, I think David's analysis is very...
And the standards too, because you're perfect.
No, I will. I'll come to that and to the investment point. I think that's a very helpful analysis. I think it's a reality check. I mean, I would wish that it would be a smooth kind of transition and the pricing becomes clearer quite soon or at the appropriate time. But I think it's more likely to be more messy. And I think so. Given that, I think the way that we've thought about it certainly is to approach this in a diversified way. And in fact, we built as David referred to, we've built a fund structure around this type of idea that you need to be diversified in this thing. And to answer your question, if there's one thing that I would think about investing in now, it is actually in this field, whether it's somewhere in the chain of climate-related investments. We are, it's any investment I think that you make, you have to have some conviction or some view that you're taking on the future. Very clearly, our view is that the prices are going to change. It may be discontinuous, but the prices will change, and the assets we're building today will be more valuable, and our investors will benefit from that because of that. So I think that's on that point. I think on the standards. Look, I think it's maybe a longer conversation you can have, on a bilateral basis. But what we have tried to do in IFC, again, it came from really very important experience that we had, as I think was said earlier, in the core of our business and investing every day in emerging markets. What emerged from all of that experience is that you want to avoid a very rigid framework of things that need to be checked off. That is an approach that may work in some cases, does work in some cases. It certainly works where you have complete control, or it can work, complete control on many elements of the project. We normally don't have that level of control. And so what we have is our performance standards, which represent a framework within which our teams make judgments about what is appropriate. So first of all, identification of potential risks. There's a series of judgment calls about what those risks might be based on experience, based on the work, and then how do you address those potential issues? And there I agree, it's more kind of defensive, a little bit more mitigation. But as you go through that process, we found that there are many occasions when our teams will identify opportunities for recycling or for energy saving or things that the industrialists themselves have not thought about, because maybe they're thinking about buying, a piece of technology and installing it, and they just want some financing, and they're thinking about it in a different way rather than a holistic way. And also because our people visit many similar facilities across the world, and over their careers, so they're able to bring experiences and share experiences from different plants and what works and what doesn't. So we certainly attempt to do more than just a kind of a compliance type of approach. But I think the key thing that we've learned is to have a framework that within which you're making a set of judgments, and those judgments can go wrong, right? You have to accept that as being part of the reality on that. Sorry. Yeah.
Aimée, did you want to?
Well, I was just going to push a little bit harder on that one, because
Please.
I think we've
Good.
been having these discussions about minimizing harm, right? Minimizing harm of investments. And you started to talk about that, about finding opportunities, but I think we need to shift our thinking, given the urgency of all of these challenges that we're facing, that are also opportunities. And how do we think about what are those investments that actually really deliver the environmental and social outcomes we're seeking to deliver, and not just minimizing harm. And in the corporate sector, you have conversations among companies about restorative activities and how they can create a restorative economy that restores our natural systems, that underpins quality of life, reduces risks of impact from climate change, is part of the decarbonization. And I just, as I think about IFC in the past, you all have been really leading in areas of renewable energy, finance, of course. But what are those other sectors across the SDGs, whether it's fisheries and others, where we need to recover our environmental system to benefit development, local development, economies? Where are those strategic investment opportunities? And I know you have firms like Encourage Capital who are working with foundations to look for opportunities like this in fisheries and grass-fed beef in the Colorado River Basin, how they can do restoration of the watershed of the Colorado River Basin on a for-profit platform. And so I think just push us to think beyond just mitigating the bad impacts of infrastructure or whatever business proposition that we're going after, and finding those solution-oriented investment opportunities.
This is great. We should,
sorry.
we have other
More
questions, but this is great. And I think, in a way, this panel is really a conversation, right? We didn't, so we'll continue the conversation after this, but just.
It's going to be a great coffee break.
Absolutely. Completely agree with the direction and the sentiment how we actually do it is definitely challenging. And I would add to that, which we only just touched on briefly, is how you scale this, right? Because we are still talking kind of, project by project, and so getting to achieve the same sort of outcomes, or bigger outcomes, obviously, but with the same sort of safeguards, but on a much larger scale, is really where it's at, and that is a challenge that is ahead of us. I think we have some answers, but not. I don't claim that we have the answer.
Well, and I think that, I'm sorry, I used grass-fed beef as an example just very quickly. I would suggest that plant-based foods, for instance, is one where, very little downside, all big upside, and huge investment opportunity because of the growth of that sector. So just, again, finding
Fair enough.
those,
Yeah,
right, we're
yeah.
not mitigating risk.
We only have about 2.5 minutes left, so I'm afraid we're going to have to do the questions and the answer. But I want to make sure we hear from you on this, Chris. What do you think? And
My view on the carbon pricing, and you can all please disagree with me, but it's the fact that no one owns the atmosphere, and so it's going to be country by country. And think about the regulatory authority in the United States and our ability to pass any laws. We can't even pass budgets half the time. So I fear that it's actually going to be a really long drawn out, and that way it will become priced into the market. I don't know that Wall Street is worried about just a sudden price drop. When we've engaged oil companies, out of the top tier, a lot of the midstream companies, it is amazing. Many of them had not, even last summer, had not heard of the discussion about stranded assets. They didn't agree with that point of view, but it got them at least thinking about it. And so I think it's a common phrase, certainly in the ESG community, in the PRI, we talk about it a lot. But I don't know that the rest of the industry has fully believed it. There's still, even in a barrel of oil, there's still about a quarter of it that is used for plastics and a lot of other things. So in their mind, sure, you don't use it for transportation, say, or lubricants, but there will be other needs for it. So it's a matter of trying to get them to understand this is coming, and the challenge is when. Because even some of our peers, PGGM, talked about cutting their carbon footprint by 2020, like cutting it in half. So, you're talking about things that are 5 years out to 10 years out. And in our world, being being right, but being right too early is indistinguishable from being wrong. So
That's true.
it's a real challenge to figure out, okay, this is coming, but what is that timing?
so we have to close. I'm going to ask, I forewarned you guys I'd ask you one question of, just to close, one sentence as quick as you could. What's the one thing to go from what I would call folk fest to center stage? We want each of these issues to be center stage in the business investment community. What's needed from each of your view? Rapid fire.
Clear, stable, predictable policy that we can all act on.
Aimée?
I think incorporating the price of carbon is just critical.
So she said price of carbon. I'll go with we need consistent reportable standards.
So we have maybe, as a
One
one-by group,
sentence.
well, it's a very tall order. We want to touch on all of these different, the policy, helping in setting carbon markets, doing the individual deals, providing the risk guarantees. We want to help across that whole range.
Okay, the full system.
Yeah.
Great. Please join me in thanking our panel for a terrific discussion. I think, if nothing else, one of my takeaways is we need to move even the words from sustainable development investing to long-term development investing, because that's what this is really all about. So thank you all so much, and look forward to the discussion afterwards.